So the first question regarding the report that I was asked is, when's it due? And as I was saying, the last day of classes is when the actual written report is due, but the oral report will be due whenever you present. And that's up to a week and a half prior to the last day of classes. But again, you probably want to present earlier for the live classes, and for the online classes, you want to have enough time where your classmates can give feedback. And I can give you some feedback and say, okay, did you take a look at this, or some of those calculations look a little funky? And it'll give you time to correct that in your written report. So it's to your advantage to go ahead and present as early as you feel comfortable, but give yourself enough lead time to finish that written report. It's 25% grade, 12.5% is the written report, 12.5% is the oral report. So both of those are worthy of doing well. And just to let you know, over half the grade is far from done. We've got another 1 to 2 exams. We've got a final exam. We have the project. We still have more quizzes. So over 50% of your grade, even though we have a month left of class, is yet to be determined. And you will have up until last day of class to do the extra credit. There's up to 10 points of extra credit, which some need more than others, and some don't really need, but might be nice to do anyways. That's the opportunities that you have to add to your grade pretty significantly as well. Other comments or questions? Does somebody want to share their screen and show the outline of the project that's in the syllabus? I obviously have the syllabus, but I'd like to see one of you please sharing your screen and pulling up the syllabus, or actually you can pull it up directly in Blackboard. It's the same thing. The Blackboard has the instructions, written instructions. So I'm going to ask that if someone can go into Blackboard and pull that up, and we'll just go down the outline and review the kind of content. And then we'll get into some of the number crunching. Number crunching is a kind of a quarter to a third of the project. You're actually going to calculate ratios and interpret them. You're going to calculate horizontal analysis. You're going to be looking at trends from last year to current year, or 2 years ago to last year to current year. You're going to be looking at vertical analysis, what's called common size analysis, where you're going to have net income as a percentage of sales, gross profit as a percentage of sales, inventory as a percentage of assets. We've done things in class to do that. So if we scrolling down, looking good, there we go, annual report project. And I'm going to give you a share trick. If you click on share screen, and this time go to the advanced tab instead of the general tab that's there. And on the advanced tab, you'll see portions of screen. Can you click on portions of screen, and it will create a box. And around that box, you will see a magnification of whatever's in that box. So everybody on the call can read it easier. And then actually, this is a trick that our assistant dean showed our dean after I showed it to our assistant dean, because it's kind of powerful if you're having trouble reading. Isn't that kind of cool? So anyways, so what I see right now is what's in the box, which I have outside the box I don't see, which is great when you're doing a PowerPoint, by the way. You can have the PowerPoint in the box and see what other slides are coming pretty gracefully, pretty easily. But anyways, that's beside the point. So the purpose of this project is to answer the following 2 questions. Would you work for this company, or would you invest in this company? And everything you're doing is leading up to those conclusions. Excuse me. So you're going to be doing some analysis. You're going to be reading your 10K cover to cover. You're going to need multiple 10Ks, by the way, not just the most recent year, but to do some of the calculations, you don't need to read the other 10K cover to cover, but you're going to need some calculations, some numbers from the financial statements. You'll be focusing on the balance sheet and the income statement for almost all your ratio analysis, your horizontal or trend analysis, and your vertical or common size analysis. There's 2 grades that'll be averaged, 5 to 10 pages, plus tables, plus graphs, plus charts, anything to support your conclusion, but 5 to 10 pages written documentation. Okay. And I do ask that you use Grammarly. Have any of you used Grammarly before? Great tool. There are so many grammar errors. I had a student last year asking me, so you're going to dock us a letter grade if I don't use Grammarly? How do you know if I use Grammarly? I said, I can tell. Grammarly will catch some of the more obvious grammar errors you will make. The there, and there, the two, and two, the words that don't even exist, irregardless. Although it used to not, regardless is the word, irregardless is not a word, but now I think it's become accepted. So anyways, so Grammarly is a tool, and it's handy to use on your resume, on your LinkedIn profile, on any papers or project you use. It's good to get to practice. So let's go ahead and scroll up a little bit. I'm just trying to scroll up and I couldn't, but that's okay. All right, so you're going to select a publicly traded company, ideally from the US. Why from the US? Because the SEC's Edgar has all publicly traded US companies' financial statements. If you want to do Adidas, great, German company. You want to do Mercedes-Benz, super. You want to do Honda, Japanese company, cool. You want to do Samsung, Korean company, the ratios are going to be the same. It might be Korean won, it might be euros, it might be yen, it might be British pounds, or it might be US dollars. The ratios are going to be ratios. Your net income percentage doesn't matter if it's Japanese yen or US dollars. It's a percentage, 5%, 3%, 23%. So the ratios will be the same. But I suggest a US company. You don't have to if you don't want to, but I suggest a US company because I know you can get those financial statements. Some of the other ones are a little harder to get. You're going to want to read cover to cover, include the CEO and president's report, the auditor's opinion letter, figure out who the auditor is. Think about what the impression that you got from reading this report. Does it relay reliability and excitement? Is it worthy of trust? Is it something that makes sense? But then number 3 says, anything that surprises you. So you're going to look and say, oh, you know what? I didn't realize they were talking about all this negative stuff. The risk of nationalization, of climate change, the risk of COVID, the risk of pandemic or anything else they may talk about. The risk of currency fluctuations, the risk of anything else that might be involved. So, and there may be some things that you feel are missing. Number 4, I would like to have seen the number of employees. They didn't tell me that. I like calculating revenue per employee. That's kind of a cool ratio. Occupancy rate for hotels or usage rate on an airline, occupancy of seats, hospitals, whatever it might be. You'll do a brief synopsis of the company, industry as a whole. You will be looking at multiple companies in the same industry for your analysis. You won't have to read cover to cover all the 10Ks. You're going to be focusing on one 10K. But you'll need financial statements from some other companies as well in the industries. Edgar is a place to jump to. As I said before, you need to look at multiple companies. Here's 3 other companies in the industry. Get the latest financials for your specific companies. And then you're going to do a bunch of analysis. Ratio analysis, trend or horizontal, common size or vertical. A minimum of the following ratios. When you present, I don't expect you to have tables of everything. I don't expect you to have a balance sheet and income statement that you copied from Edgar, posted in your PowerPoint or whatever other tool you might use. I also don't expect a balance sheet or income statement in your annual report, written report submitted. I expect analysis, ratios, calculations. You'll have an income statement, but it might have vertical analysis with the percentages right next to the column of numbers. You might have horizontal and some changes in the tables on a balance sheet or income statement. But the original balance sheet and income statement, I don't expect to see. I can look it up just as you can in Edgar, but the calculations, I do expect you to have calculated tables and refer to those tables in the appendices of 5 to 10 pages of text plus appendices. And you can refer to the appendix on Appendix A, which has a vertical analysis of the income statement, yada, yada. That showed this compared to this company or that company that showed this and showed that. My company appears to be strongest, weakest, whatever evaluation you're going to be doing. But you're going to be looking at these companies in the light, would I invest or would I work for the company? So you're going to do a whole bunch of analysis, a bunch of ratios. We'll scroll down to number 8. Answer the question. Would I consider working for or investing in this company or industry? And a little bit more than a yes or no, please. I say, yep, yes, yes. That's not the answer I'd ideally be looking for. It's yes, because, no, because. Maybe you're not, you like Apple, but you're not going to invest because you think the stock price is too high and they've already reflected all the, it's not going to grow enough for you. Or maybe you don't want to move to Cupertino, California, or you don't want to go to Battle Creek, Michigan for Kellogg's, but a great company, great benefits, you might consider because you like the snow. But whatever it might be, you might have other reasons, both quantitative, follow the numbers, and qualitative. Quick show of hands. How many of you are fairly comfortable in Edgar, accessing Edgar? Shanice, no? And yes, kind of, sort of. CRL, kind of, sort of. Yeah. You were showing me your skills, which is good. You were there. So I'm going to do a show and tell in Edgar, and I'm going to walk through, and I'm going to. I'll take over the screen. I'll share my screen, and let's go in. So my first question is, any particular company you want to take a look at, and I urge you to select a company that you think might be interesting. And how might I define interesting? Is it something that, well, a company I might be interested in working for, or an industry I might be interested in working in? Or I've got family members that work for this company. Or I think it might be interesting for whatever reason you think it might be interesting. I want you to go ahead and pick a company that has some meaning. And why do I do that? Because I will tell you, if you want to go to work for a company or an industry, and let's say you want the automotive industry, and you've looked at Ford or GM or Chrysler cover to cover, done some analysis, you will differentiate yourself from 99+% of the people who don't read the annual report. Everybody's going to go to the website. Everybody's going to follow the news. They'll Google search the company and say, oh, here's the latest. The president said this of the company, and they're investing in this, they're buying that. They're having challenges in this country or whatever activities are going on. Yeah, the news is kind of interesting. But if you can do some financial analysis and ask a question like, I know sales have been going up the past 3 years. As a matter of fact, the past year, sales went up 8%, but profits are down 5%. Any insights as to what's going on that you're selling more, but it's not making as much money? And first of all, they'll be impressed that you asked a question like that, because you actually read the financial reports. The person you may be talking to may or may not. Okay. I mean, Sunoco here in Hartsville, they lost money last year, but sales went up. And if you look a closer look, you can see why they lost money. There's a line item below the line, below operating income, that affected that. But that's kind of the analysis. If you do enough of that analysis, you will impress your interviewers and you will put yourself to the head of class. You'll rise high on the list, but they're also legitimate questions. You don't want to go to work for a company that's declining, losing sales, that's losing profits, because guess in, you know about inventory. Last in, first out, not just an inventory method. It's sometimes a method of people getting fired for a company that's on the rocks. So last people that got hired, you're the first to go by. So you want to make sure you make analysis. And I will tell you, when I was looking at schools 3 years ago, I just came here 3 years back. I looked at financial statements of all the schools that I was considering. And FMU was the strongest, and that's not really the only reason I came, but they were the strongest financially. No debt, essentially. They had a consistency in income statement and balance sheet. And I did look at those. And yeah, they get a lot of state monies, but the state's not always a reliable source. But they trust me that the financials at FMU are pretty strong. So you're in a good place, and I anticipate, never can predict the future, but being around for a while. The school will be here for a while. So that's give you an idea of kind of the analysis will prepare you to better understand your business. So pick either a company you're curious about, in an industry that you know, want to know, or maybe know nothing about. Maybe you're thinking of going into banking, or thinking of going with the airlines. You like to travel and say, hey, I hear all these folks working at the airlines get free travel around the world. Well, take a look at the airline's financials and get some insight onto the numbers on how an airline runs. So those are some of the ideas. So I'm going to go into Edgar. I'm going to share a screen. I'm going to ask you to pick a company. Any companies in mind that you want to take a look at? I'll give everybody a chance to chime in, and then I'll pick one of the three.
I tried to look up Blue Cross Blue Shield, but it didn't have all the information that was needed for the worksheet, so I changed my company from there.
Okay, so it has to be publicly traded. And so, okay, let's do a quick, I'm going to do a quick look, and I'm going to go into, separate the tabs. So Blue Cross Blue Shield. See if they're publicly traded. Okay, so the company's name is Anthem. Did you get that far? Okay.
No, I think I did just put in Blue Cross Blue Shield, and I think
Yeah.
they had like it didn't say Anthem on it though.
Okay, so the parent company is Anthem. So you say, I want Quaker Oats. Well, Quaker Oats is owned by PepsiCo, right? Or I want Kentucky. Let's see, it was a KFC, Pizza Hut. They're owned by Yum Brands. So you type in Pizza Hut, and right now when I say ticker symbol for, let me try. I'll try that. Ticker symbol for Pizza Hut. What's it going to come up with? There it is, Yum Brands, YUM. So Pizza Hut is a separate division, but Pizza Hut is owned by, has a parent company. So let's do Yum Brands. Okay, they're trading at 116 bucks a share. The absolute number is meaningless. Anybody know what Berkshire Hathaway, which is Warren Buffett's company, is trading at for one share? I think it's about $500,000, about $500,000, $520,000 for one share. Don't you wish you bought it when it was only $100,000 a share? No. Anyways, all right. So let's look at Yum Brands. Well, I'll go back to Edgar. So I'm going to go into Edgar. Any other companies you want to take a look at? And we can look at Anthem later on too. But Anthem doesn't have. Some companies don't have a cost of goods sold. Airlines don't. They're not selling you planes. Hotels don't. They're not selling you rooms. They're renting you rooms. So Blue Cross Blue Shield's insurance company is going to be a little funky, which is why we can look at that later if you like, and we can go into Anthem and do the same analysis for Anthem. Might be interesting. So I'm going to be here. I've got my SEC stuff. I did a Google search for Edgar. I'm going to go search and access here, and then I have available to me full text search. Company or fund, I'm going to do a company or fund name. Okay. So when I go there, there's going to be one trick I'm going to ask you to go at, and you're going to want to look at the classic view of this stuff. Right? So we're going to look up a company. What company did we say it was? There's Yum Brands. There it is, Yum Brands, ticker symbol YUM. Not Yummies, which is YUMM, but Yum Brands. Now, important that you do the following. You can look at the 10K here and do all this manual calculation. You can view the filings here, but I'm going to go up to classic version in the upper right-hand corner. You want to make sure to hit classic version. And under filing type, you got 305B2, 10K, SG 13G, amended 13G, okay, 8K. I'm going to go filing type. What filing type do I want? If I type in 10K, I get nada. I get nothing. Challenge is I need a 10-K. So the syntax is kind of important. You type in 10K, you're not going to get anything. But if you type in 10-K, you can get a whole bunch of stuff. Here's my file, February 23 to 22. That was just this year, February 21, February 2020, February 2019. And then I'm going to go to interactive data. When I go into interactive data, I've got the 10K itself. I've got notes to financial statements. I can read all this stuff from here, but I'm going to go to financial statements. And I've got two things here that look like income statements. One says consolidated statement of income. And by the way, when we were looking at Amazon a little bit earlier, we saw consolidated statement of operations. It didn't say income statement anywhere, but that operations had a revenues for the first line, had expenses after that. But if I look at the consolidated statement of comprehensive income, and I want it to be my income statement, it needs to start with revenues. My comprehensive income statement starts with net income. That's not helpful. Then I have translation adjustments and comprehensive income loss, translation adjustments, foreign currency, pension unrealized gains and losses, pension reclass. This is one funky income statement. And it's a comprehensive income has some special meaning in accounting. If you go to some advanced courses, you'll hear about what that's really about, what it means. But if I go to the statement of income, oh, there we go. I got revenues. I've got restaurant expenses. That's for company restaurants. I get SG&A. I got franchise and property expenses. So I do add a franchise model here. And there's my revenues, SG&A. I go down to my earnings per share, and I go right above that, and there's my income. So I'm looking here, I'm saying, okay, I got total revenue of 6,584. If you tried to tell me that Yum Brands, which includes Pizza Hut and a whole bunch of other franchise groups, has $6,000 in revenues, I'd say, wrong. What is that number really supposed to be? Well, if it's in millions, I need to add 6 zeros. So 6,584,000,000. Now I'm looking at horizontal analysis. I see it went from 5.6 billion to 5.65 billion to 6.5 billion. There's quite a jump. They went up 900 million, 1.1 billion, almost 20% in 1 year. What happened to their net income? Even though sales went up this second year, 5.6 to 5.65, their net income went down. And with their income going up over 20%, they had almost 40%, over 50% increase in net income. So that's some horizontal analysis that you'll get to do down the road. And again, I went over to the earnings per share. The stuff below here, don't worry about it. The other revenues, company sales, they split out other stuff. Just go to the earnings per share and go to the line above it. And you'll be able to see the numbers you need from the income statement. And then for my balance sheet. Now notice you had 3 years of an income statement. I've got 2 years of a balance sheet. So when I need to take average assets or average receivables or average inventory, I'm going to have to go in and have not only 1 year's worth of balance sheet, but I'll need to go to the previous 10K to get some more numbers out of that. So let's go down, and I'm going to go one more trick. I'm going to do something called view Excel document. This is why I want you to use the classic view. Excel is your friend. You are expected to understand, know Excel when you graduate. I urge you and encourage you to use Excel in this project and for almost any other projects you can. So instead of manually typing in numbers, I might say, so what's my total liabilities? Here it is, 14,339. I could type in 14,339 and I have equity, total liabilities. Okay, total comma stock. Why am I not seeing total? Here I go. Okay. Again, shareholders' equity, including total liabilities, redeemable line. Okay, there we go. Total liabilities and equity. Total liabilities. Yum Brands has been losing money. I have negative equity here. Not accumulated retained earnings, but accumulated deficit, accumulated losses, stockholders' equity. So Yum Brands is an interesting example that's in pretty deep duty. Okay. My liabilities of 14.5 billion exceed my assets of 6 billion. And a legitimate question is, how are these guys still in business? And that is a legitimate question. So this is an example, and you're saying, wait a minute, you said this was Pizza Hut. Where's the inventory? Doesn't Pizza Hut have inventory? I see cash, I see receivables, I see prepays, I see current assets. I don't see any inventory. I see property, plant, and equipment. I see goodwill, intangibles, other assets. You got total assets. But I'm looking down here and I'm saying, there's something screwy going on. I do not see any inventory, but the reason you don't see inventory is because it's a franchise model. It's like Wendy's, by the way. Wendy's has more franchises than company-owned stores. Pizza Hut does have some company-owned stores. So there's no real inventory here. So if you need to calculate an inventory ratio, you weren't going to get it. If you need to find the cost of goods sold, we'll go over the income statement. You're not going to find classic cost of goods sold down there. So this might be a hard analysis if I was saying, well, I want pizza restaurants. Maybe I want to look at Domino's. And then I'll go in, I'll say ticker symbol for Domino's. And let's see if there's a parent company here or if it's actually Domino's Pizza. DPZ, $400 a share. You say, wait a minute, Yum Brands, which has a deficit of a lot of $1 billion, was over $100 a share. And Domino's Pizza is almost $400 a share. Let's go into DPZ. I'm going to go back up here. And let's look. Yeah, I'm getting hungry. Maybe I haven't had lunch today. That's why I'm talking pizzas. All right, so let's go over to DPZ. I'm going to just back up. And I'm still going to do classic version once I get to DPZ. I might type in Domino's and it actually shows up. Or I could type in DPZ. I prefer ticker symbol because that's the only one. Domino's might have multiple Domino's divisions, investment companies, whatever. Again, don't forget to load in the classic version. Now you're going to go to 10-K. Interactive data. And here's my financial statements again. And this time I have consolidated balance sheet parenthetical, which I would disregard. Statement of income, comprehensive income, stockholder deficit. They're losing money too, I guess. Let's go look at the balance sheet. So I'm looking at, let's go down to stockholders' equity. They're in deep doo-doo too. Again, let's see, is this in millions, billion, thousands? What's the number? In thousands. So I have to add 3 zeros. So I've got not 1 million, but 1,671,000,000 in total liabilities and deficit. I've got 5.88 billion in total liabilities. And I've got 1.67 billion in total assets. So right now, I'm not real excited about any of these companies. Because I'm looking at these, I'm saying, let me look at the income statement. Consolidated statement of income. And you can do this. By the way, the company you chose to analyze for any of the postings on Edgar, on Blackboard or analysis, you can change your company if you want. Look at the revenue, it's increasing, 3.6 to 4.11 to 4.36. And net income, they're profitable here. So they are making money and they're making more money, but they got into deep hole somehow. And by the way, they don't call this cost of goods sold. They call this cost of sales, which is the same thing. Cost of products sold. If you're an oil company, it might say cost of oil. And you might have to calculate your own gross profit. Revenues minus cost of sales is gross profit, which actually they call it operating margin. So they calculate it for you. G&A expenses on down. So I can do some things. I'm going to do a quick view Excel document. Let's jump to the Excel document. If I view Excel document, and that's one of the reasons I like that classic version. It's the only way you're going to get it. When you get the Excel document, I'm going to open it up here. And we're going to have the ability to edit this directly. And the first thing that you're going to need to do is enable edit, which I'll do right here at the top. And if you look at the bottom, I have all these tabs going on. So I'm going to get rid of my and at the bottom here, those tabs that you have, I've got a consolidated balance sheet, parenthetical. I've got a statement of income. So let's look at our income statement right here. I've got total revenues, cost of sales, operating margin. I might want to calculate my net income percentage. What's my net income percentage? 510 out of 4,357. For every dollar's worth of sales, this is my 100% number. I'm going to go equals that slash that. And I get a 0.11715. To make it readable, I'm going to make it a percentage. 12%. I like one decimal, so 11.7%. How does that compare to prior years? I'm going to copy that formula over. They're pretty consistent. It was 11.9% the year before as a percent. It was 11.1 before that. So they're pretty steady state. They jumped and then they dipped a little as a percentage. Sales went up a whole bunch, but net income as a percentage of sales went down actually. They had a little more with some other expenses going on, a whole bunch more. Every one of these line items is more expensive. Okay. So G&A, more general administrative expenses, more franchise advertising. So that's what's going on. But you can do some pretty quick calculations here in the analysis. That's why you want to take advantage of the Excel capabilities. Let's go ahead and let's go into Anthem right now. Okay, because that was one that was requested. I'm going to close this out. Any questions so far on this, by the way? How many of you think you can do this? When you do Excel, you can do the analysis, you can punch it in and do some quick calculations. So let's go over to Anthem. I'm going to back out of here. And go over to Domino's. Let's go over to Anthem. So I don't remember what the ticker symbol was. Right, it sounds like ANTM, that's the one. There's a bunch of Anthems here, by the way. Anthem Golf, Anthem Digital, True Anthem, but I'm pretty sure this is the one. And don't forget the classic version. We're going to go back and get our Excel spreadsheet going. And somehow, so I go down here, and again, what do I have to type in? You can see it there. There's a 10K and 8K. It's a dash. Another 10-K. Interactive data. And I'll go over the financial statements. Balance sheet, statement of income. Let's look at income statement. Let's see how Anthem's doing. So what kind of revenue? Oh, they have premium, insurance premium revenue. And they also sell products and administrative fees they collect, operating revenue. And then they have investments, investment income, because they have a lot of cash that they have to put in investments, gains on the investments, total revenues. Their cost of goods sold is actually cost of products sold. Okay. So when you look at that and say, oh, that's what that is, here's SG&A. So here's their net income. They went from 4.8 million, so 4.8 billion to 4.6 billion, jumped to 6 billion. Steady increase in premium revenue. Steady increase in product revenue. And when you read the annual report, you figure out what the products they're selling are. Administrative fees increasing, operating revenue. Investment income dipped here in 2020, but back up. The total revenues are increasing pretty well. You're doing a trend analysis, there you go. Again, I'm going to go over to the balance sheet. And I look down here, I've got cash and cash equivalents. I've got self-funded receivables, premium receivable. There's our account receivable there. About 10% of the, a little over 10% total. Oh, sorry, 97, almost $100 billion in assets, of which 26 in securities, so a quarter of that is being held on securities and investment, equity securities, premiums receivable. So by reading the cover to cover, this is not like Walmart. This is not like Ford. This is not like Amazon. So when you're looking at this, you're saying, oh, this is kind of interesting. And you're now analyzing an industry, the insurance industry, and saying, oh, this is a little different than what I looked about inventory turnover. So I don't have inventory. Anybody see any inventory in my current assets? Nada. So I can't calculate an inventory turnover. Receivables, I'd call them premium receivable, called by my accounts receivable. And they have some other receivables, but accounts receivables, they're calling it premium. So that'd be a little bit confusing. The carrying amount of the balance sheet from agents and insured, uncollectible premiums and others, net of allowance for doubtful accounts. We know about ADA. So that sounds like accounts receivable to me. But again, some of the terminology may not be what you see in the book you've been reading and studying. And we've been talking about that in the semester and the lectures I have on Blackboard. Those are things that terminology, cost of goods sold, cost of product sold. When you say return on assets, that's net income over average assets. Earnings per share, that's net income over average number of shares. Okay. Net income percentage, that's net income over net sales. So earnings, net income, return, all the same term or all the same number, but using different terms. So let's go back. Let's pick a little more company that we might know something more about. Let's go ahead and pick Amazon. Amazon's a cool company. For the first 7 or 8 years, they didn't make any money. For 19 years, Tesla was running losses. You're saying, wait, Domino's has losses. Yum Brands and Pizza Hut folks have losses. Tesla had losses for 19 years. The short answer is yes. Let's look at Amazon. AMZN. Again, we're going to want that classic version. We're going to go over, type in 10-K. I'm going to take a look at interactive data. And I'm going to cut to the chase. I'm not going to look at the financial statements individually, other than to say, which of these do you think is the income statement? Statement of cash flow, statement of operations, statement of comprehensive income, statement of comprehensive income consolidated, balance sheet, parenthetical balance sheet. Which of these is an income statement? And I'm going to number these. 1, 2, 3, or 4. Show me by number of fingers. Which of these do you think is the income statement we're going to use for analysis? 1, 2, 3, or 4. Show me, give me a count. Everybody, it's time to participate.
2.
See your eyes. You get a vote for 3. Okay, let's take a look at 3. Consolidated statement of comprehensive income. What does it start with? Well, here's a favorite thing. Does it start with net sales or net revenues? Oops. Does it have expenses, currency translation? Oops. Foreign currency? No. Unrealized gain, losses, available for sale, debt securities, reclass, net comprehensive income. That looks a little funky. Anybody want to take another guess? Show me another finger count.
2.
2. I get a vote for 2. I kind of like that one actually, because this starts with net sales. Oh, that looks reasonable. Cost of sales or cost of goods sold. Fulfillment, tech and content, marketing, G&A, general administrative, operating expenses, operating income, interest expense, other stuff. Bottom line, above the earnings per share, I got 33. Now, how many zeros do I put out? It's in millions. So I got $33.364 billion on sales of $469.822 billion. I'm adding 6 zeros. So I'm going to cut to the chase now. I'm going to go to view Excel document. I'm going to open that up. And we will see at the bottom all these tabs. I have to enable editing. And I've got audit information. Oh, who does the audit? EY. I used to work for EY, Ernst & Young. Statement of cash flow. We have operating, investing, financing. Those are the three categories, but that's a cash flow statement. I'm not going to use that. Here's our statement of operations. Where is cost of goods sold on here? Does anybody see a cost of goods sold?
Cost of sale.
You bet. Cost of sales is cost of goods sold. How do I calculate gross profit? I do not see a gross profit number on here. How do I calculate gross profit? Any takers? You know this. You know this stuff. Take a shot.
Sales minus cost of goods sold.
Sales minus cost of sales, or by cost of goods sold. So I'm going to actually go ahead and add a line for that. And I'm going to calculate it right here. Actually, I'm going to call it gross profit. And I'm going to say equals that minus that. I'm going to copy this formula, Control C, over there. I'm going to shrink this column because it's kind of a nuisance and getting in the way, so I don't need that big a column. Okay. Can you all see this? Is it big enough to make sense of? Okay. So if I want to calculate my gross profit percentage, and I'm going to do this for 2021, 2010, 2019 rather. I can count. Same thing, very easily take that number slash that number. See, get copied over. And we'll make all that a percentage. Just get out of my hair. Okay. I don't want that to be percentage. So I'm just going to add that as a number. So there you go. And I can do the same thing. I can actually do my common size income statement for all these numbers. Earnings per share, I admit it. So, oh, but that's not going to work because I need to have it $B, $3. That's my fault. I'm sorry. Actually, it's going to be $. Try it again. Got this relative absolute referencing thing going on. That's better. So I can see that my gross profit, which is, this is my 100% number every time. $58 and $42 is 100, 60.4 and 39.6. So there's a check there. I want to do this. You can underline here. Just to make it a little to differentiate. Okay. So anyways, we go to the bottom line and we can see here that our net income was 4% two years ago. Last year was 5.5%. This year it's 7.1. That's kind of a decent trend. The numbers here, if I told you like 11 billion, 21 billion, 33, horizontal analysis would be a little different. I take the current year minus the previous year. So I'm going to just do a quick calculation. I'm going to take current year minus the previous year, divide by the previous year. So I went up 56% in sales. I mean, in net income. The previous year, I was up 84%. I went from 11 to 21 billion dollars. So they're doing some pretty significant net income increases. So if kicks do the same thing here, or my horizontal analysis. My sales went up 37% from here to here. They went up 21.7% from here to here. So again, you can very quickly in Excel do some number crunching and say, wait a minute, and again, I'm using these numbers down here, 84% increase based on a 40% increase in sales. I had an 84% increase in profits. I had a 21%, 22% increase in sales, and I had more than double, 56% increase in profits. No wonder Amazon's doing so well in the stock market. Is this stuff making sense? So how do I calculate inventory turnover? Let's go ahead and insert some columns here. I want to do inventory turns. What two numbers go into inventory turnover? Go ahead and unmute. Give me two numbers that go in inventory turnover. Well, give me one that's obvious. You can come up, you can tell me.
Inventory.
Inventory, thank you. Excellent start. What's another number that comes out of inventory? That's on inventory turnover. Well, inventory is at cost. Sales are
Cost of goods sold.
cost of goods sold. Outstanding. Thank you. Which is a bigger number, cost of goods sold or inventory?
Cost of goods sold.
I get a vote for cost of goods sold, keeps increasing. Where inventory goes up and down, cost of goods sold increasing, you're right on. So the cost of goods sold is going to be in the numerator. So the formula should be cost of goods sold divided by what kind of inventory? It's an inventory number, but there's something special about this inventory number. Cost of goods sold, average, thank you. Cost of goods sold for a full year, inventory at a point in time. I need my beginning and ending off my balance sheet. So I'm gonna take an average. So my inventory turns for, we'll do 2021. I'm going to take my cost of goods sold. So it's going to be equal the cost of sales divided by, I gotta take an average of my inventories. Where do I find my inventories? Well, I've got cash flow, operations, statement of changes. So let's go back here. Audit, cash flow, operations. Where's my balance sheet? Statement of comprehensive income. Consolidated balance sheet, there it is. So I've got these two numbers. I'm just going to copy over these two numbers for kicks. Let's see, go back to here. Copy the numbers here. I shouldn't have started it there. All right, let's try that again. I'm going to go over to my balance sheet, get my two numbers, and get my inventory. I need these two numbers. Again, I could have left them there, but I just wanted to, for show and tell, I want to demonstrate that we're going to put them over here. Those are my inventory numbers. So I'm going to take the average of these, and I'm going to take my equals cost of goods sales slash, two parentheses here just for kicks, that plus that close parentheses, /2, close parentheses. And there, that's in dollars. I don't want dollars. I'm going to change the kind of formatting for that. It's not a dollar amount because I have dollar divided by dollars. I got a number. I've got almost 10 turns. 9.6, that's my inventory turnover. So I'm letting Excel do the work for me. I'm not punching numbers in the calculator because that's going to be a lot of work. But I'm seeing that I've got 10 turns. Is that good or bad, you think? Give me a thumbs up for good, thumbs down for bad. Give me a side saddle for it depends. It depends. How did we do last year? How do our competitors do in the retail space? I mean, Walmart does a lot of online sales too. Are they competitors? I'd probably consider a competitor more so than eBay or Microsoft or Apple, because these, not that they're, it's not just technology companies selling stuff. So this is the kind of analysis you can quickly do with all the ratios. You saw some trend analysis. You saw some vertical analysis. These are the kind of tools that are at your disposal when you use Edgar and you're able to use the Excel format in reading through this stuff. Comments or questions? Go ahead and come off mute. Let's talk about it. I just covered a lot of ground. And I know that I'm going to have this recording. I'm going to post it on Blackboard, so you'll have access to it if you want to review it. You can probably play it back faster if you like. But again, this is the kind of stuff that you can do a quick analysis, or you can get more involved. You're going to create your own tables. You're going to include those in the appendices. You're going to evaluate based on those tables. You're going to make some charts, some graphs, maybe bar charts, pie charts, line charts, whatever it might be, line graphs, and then interpret based on those and compare them just to yourself in the same company from prior years and some other companies in the industry. So we covered a lot of ground. Did you find this helpful? Kind of still confused, or you want me to start over again?
I think it was helpful.
Okay.
Yeah, I agree as well. It was helpful.
Okay, good. It was meant to be, hopefully. But again, not only are you hopefully have a better feel, better understanding, but now you can, and by the way, if you want to review any of these numbers with me, or if you have questions on calculations, or how the heck do I get this? Because I'll tell you, when I say debt, what's a debt ratio? Measure of solvency. You can say, well, I've got current liabilities on my balance sheet. I have total equity, but I have a whole bunch of long-term liabilities, but there's no total liabilities. So you might have to go and calculate that. Let's see if Amazon gives you total liabilities. So I'm going to go ahead and share my screen again. I'm going to go over to my balance sheet. And as I said, if you look at the balance sheet, I've got current liabilities, accounts payable, accrued expenses. I have total current liabilities. That's cool. I've got some long-term liabilities, long-term debt, other long-term liabilities. I do not see a total of all liabilities, because what's my debt to asset ratio or my debt to equity ratio? It's total debt, total liabilities. I have some students, I tell you, that will take and tell me their debt to asset ratio is 1. They'll divide, oh, it says total liabilities here. They'll take that number and divide it by total assets over here, and they'll get 1. Wrong. This is total liabilities and equity. So the easiest way to find total liabilities, if it doesn't tell you already, is to take your total liabilities and equity and subtract out just your stockholders' equity. So I took this number, which is the same as total assets. I subtracted out the total equity, and I got my total liabilities. And so my debt to equity ratio equals that slash that. So I've got 2/3 of my balance sheet is debt, 1/3 is equity. Multiply 67%. I can go one step further. I could see if that total liabilities is true. I could say, I'm going to do a sum function. I'm going to do sum. Okay. I'm going to add my long-term liabilities, my long-term debt, and my current liabilities to get my total liabilities. I got 4 line items here. And if all goes well, that 282,304 equals 282,304. So I could have added up all the liabilities, current liabilities plus those line items, the long-term liabilities, I get total liabilities, like I did right here. Or I can do one calculation, subtract my equity from my liabilities and equity and get long-term liabilities. So you see that on a quiz or a test, you might have to know how to do that because it doesn't say total liabilities anywhere. And I've had students panic, it doesn't tell me my total liabilities. And I'll say, well, can you calculate it? Because we know the formula, assets equals liabilities plus equity. And if you rephrase that, assets minus equity equals liabilities, basic algebra. There you go. So all the numbers are there on the balance sheet and the income statement for almost all the analysis. You need a stock price, you're gonna have to look up the stock price. That's publicly traded because it's not going to be, this is going to be stock price from 3 months ago, whenever the statements came out. Current stock price is what you need for some of that analysis. And then there are folks that recommend the stock. They might say it's a buy or a sell or hold. And you have gurus out there saying they're undervalued, they're overvalued, or they're on par, they're valued reasonably. So all those things that get evaluated, you can look at other people, what they have to say. I can guarantee you, nobody knows which stocks are going to go up and which stocks are going to go down. And I can also guarantee all stocks are going to go up and they're all going to go down. The question is when. So if I do that last answer, I'd be retired 30 years ago. But I don't intend to retire. So we're good. Any other questions? Anything else on your mind? Like I said, we covered a lot of ground, we covered a lot of information, but it's a lot of powerful stuff. And this is a tool that you can use, and you're going to be using ratios and analysis of finance. You're going to be using it to evaluate maybe companies you want to invest in or want to work for. Not just for this class, but you start saying, I'm choosing between 2 or 3 companies. You want to see who's growing faster. That might have more growth opportunities for you. Or you might want someone steady state, you don't like change, and you want to get in a company that's, yeah, utilities have been around a long time. They're still going to supply energy. Cost structure may change a little bit, but overall, energy goes up and down, oil's up, oil's down. We're good to go. Other questions or comments? Or anything else in your mind? I'm going to go ahead and stop the recording.